Sure. So the issue is that when the U.S. government, the Treasury, the Congressional Budget Office, the Office of Management and Budget, measures its debt and its interest payments, what it does, it uses an accounting framework. That is, it measures its debt at its par value, and it measures its interest payments by summing up the coupon payments on the long-term debt, so just the official interest payments, and then it takes the capital gains on the zero coupon Treasury bills. Okay. Now what's nice about that framework is it doesn't require any judgment. It's very clear what the rules are, and it's very clear how they compute those costs. So no judgments involved. The problem is it's not what investors or the other side of that trend of the others, what its creditors care about. And it's not what would be sort of consistent with economic theory when we're thinking about what are the costs of borrowing. So as an investor, what you care about is not just the coupon payments that you receive, but also the capital gains and losses that you earn on the debt. Sure. That is, as the value of that debt goes up and down, you care about those capital gains, just as any investor would. So what we did was and then I should note that this is all joint work with Tom Sargent of New York University. What Tom and I did was to create a parallel set of accounts for the US government, in which we're measuring, the key differences are that we're measuring the US debt at its market value, and we're measuring its interest payments by the holding period returns on the debt. That is taking into account the changes in the bond prices. So as bond prices go up and down, that's giving capital gains and losses to its bondholders. And you might say, well, why does this matter? And you say, well, during times of sort of peace or relative calm in financial markets, it's not a big deal. Essentially, the Treasury, when it sets coupon rates on new issues, it sets coupon rates so that the market value about equals the par value. And in general, if interest rates are pretty stable, it's not the difference between the market value and the par value is going to be small. So you can say, well, why does this matter? But well, it's going to be at times of fiscal stress, during times of crisis, that the market value and the par values are going to differ. And bondholders are either going to get big gains or they're going to get big losses. And so when do you tend to see these things? Well, times like particularly war times, you see it like World War I, World War II, you see this in a big way. Or if interest rates are moving in, you've got large movements in interest rates. So like, for example, the early 1980s, when Volcker raised interest rates to bring down inflation. And what's important is that it by showing the market, by reporting the market values and the holding period returns on the debt, what it really does, it illustrates who really bears the costs of various government spending and expenditures. And some of these costs can be hidden if you're just looking at the par value and the accounting measure of interest payments. And I think where people have looked at particularly the US government spending and looked and said, boy, there appears to be free lunches here. There's kind of there's a crowd out there that basically says, a lot of government spending, there's free lunches. And you say, well, government spending might be a fine thing to do. I'm not opposed to government spending, but somebody's going to pay the cost. The bills always get paid. And you want to kind of identify who pays. And by looking at the market value of the debt and the holding period returns, it becomes clear who pays.
So who pays, the taxpayer or the bondholder?
So that's the big question. So there's basically three groups that can pay. If you've got it can be either the taxpayer that pays, the bondholders that pay, or it could be that future recipients of government spending incur the cost by cuts in spending. But somebody's got to pay the bill. And if you report the debt at its par value, then the bondholders can never really take the hit because you never record the losses to the bondholders. And sometimes that's true. And also if interest rates say fall and bond prices go up, actually bondholders may be getting a gift from the government. The government can actually transfer wealth to its bondholders. So the transfers can kind of go both ways. And so so Tom and I got into this, setting up this sort of separate second of accounts actually in the 1990s. In particular, thinking about that was a period in which government was talking about paying down its debt and things like that. And be honest, it didn't make a big difference during that period. It was more sort of a historical thinking about crises. I'd say, there wasn't a huge amount of interest in it. We got encouraged to look historically, to look back on history, and it's true that it makes a big difference when you look at like who paid for the cost of wars, whether you measure things by the market value or the par value. So we went back and did this historically, and we kind of developed a little bit of expertise in thinking about war finance and who actually pays. And we wrote papers and people said, oh, that's very nice. But then COVID hit, and the financing of COVID looks an awful lot like the financing of a war.
But that's very interesting, because from the research piece that I read from you, you were talking about, okay, we have a decreasing reliance on bonds and more reliance on taxes, right?
In
But
general,
now,
yes.
in general, now COVID seems to have kind of really changed that, right?
Yes. So COVID, essentially, we did not raise taxes at all to pay for COVID. Okay, so we spent about $5 trillion. The United States spent across 2020 and 2021. We spent about $5 trillion to fight COVID, or in response to COVID. That's about a quarter of a year's worth of GDP. So that's a big number. Okay, 5 trillion. We did not raise taxes at all to pay for this. So we financed it all through borrowing of various types. Okay. And so basically the Treasury issued debt to finance, to pay for these expenditures. Much of the increase in debt was purchased by the Federal Reserve, who then you say, well, how'd the Fed pay for these bonds? What it did, the Fed expanded its borrowing from the banking system in bank reserves, and also it borrowed from the money markets through its use of reverse repurchase agreements. So basically what we did, if you want to kind of think about it, was we increased the spending. The U.S. government, Congress and the president increased spending, government spending. We financed it by issuing bonds. Those bonds were, in practice, there's a nuance here, but were essentially bought by the Federal Reserve, and the Federal Reserve paid for them by borrowing from the banking system and the money markets. And so, and then you say, well, how the money? And
borrow,
so that's
borrow
basically
short,
how we borrowed it.
Borrow short
and lend long. If you
yeah,
think about
exactly.
what the Fed is this is an idea of Marvin Goodfriend's back with quantitative easing. It's the Federal Reserve, is an $8 trillion hedge fund. It borrows short, it borrows overnight, and then lends to the federal government with long-term debt. And so it does maturity transformation. And then of course what it did was it then raised interest rates on itself. And so it raised its borrowing costs. And so the Fed's now making large losses, as it's gone there. But that's another topic. But actually, that's again like sort of measuring the debt at its market value. You get that you realize that the Fed, by raising interest rate, it raised its borrowing costs. It lowered the value of the bonds that it holds, and it's imposed $1 trillion of capital losses on itself, and it's now losing $2 billion a week in interest payments.